Welcome to Toukan Expert Sessions. The presentation will begin shortly.
My name is Mamoun Toukan. I have over 10 years of experience in shipping and logistics, working at Arab Transit based out of Amman, Jordan, a company that offers a number of services from shipping agency to freight forwarding, customs clearance, transportation, 3PL and 4PL services. In addition, along with my business partners, we founded a company called ArcFlow that aims to digitize supply chain processes. I'm passionate about global trade and logistics and hold a master's degree in supply chain management from MIT and a Bachelor of Commerce degree in finance and economics from the University of Toronto. In this session, I'll be talking about how to calculate the total landed cost and what are certain considerations to keep in mind and its importance for every business, especially ones dependent on international trade or either sourcing or selling products globally. So a quick brief before we begin. Today's supply chains are global. A final product may be assembled in one location, but inside components and raw materials might be sourced from different countries. The process and considerations of transporting materials or products from international vendors differ significantly from when sourcing domestically. When it comes to sourcing from international vendors, calculating the total landed cost isn't as straightforward and not simply adding cost of the product plus freight. There's a number of factors that come into play. Some are not so obvious, and not factoring them in might actually impact profitability big time. A big disclaimer, there's no one single strategy when it comes to where to source from, the delivery terms, method of delivery, as it will all depend on several things. And the strategy might change over time based on trade agreements, freight rates, among other factors. So the aim of this discussion is to shed light into the factors you should consider when calculating the total landed cost or comparing vendor quotations and freight options. I'll start off by defining what total landed cost is, then explain why is it necessary, followed by looking at the components of each cost item and what influences these cost items. And finally, we'll wrap things up and give into a conclusion and hopefully by the end of this discussion, you'd be convinced as to how important it is to be spending some time on calculating the total landed cost and having some general framework of what are the items that you should be considering. They might change based on transportation method, locations, whether there's a trade agreement or there's customs duties. So let's start off. First, define the total landed cost. So the total landed cost represents the total cost of a product, including its journey from factory floor to the buyer's door. It should include everything, including the warehousing or distribution centers, costs to consolidate or break order quantities, the freight charges, customs duties and taxes, port charges, transit time, among other items. If you head online, the general formula is as follows. Landed cost is equal to the product cost, which should be fairly straightforward. It's whatever the vendor quotes, plus shipping, plus customs, plus risk, plus any overheads. And we'll drill down into each item shortly. So for the sake of imagination, say a product was brought from the US by a buyer in the UK. The journey from the seller's site to stuffing a container to export formalities and shipping it to the port, followed by customs clearance, delivering it to destination, and there might be a warehouse in the middle, should all be factored in. Additionally, the port, the duties, taxes, as well as transit time should be factored into the cost calculation. So why is it important? As mentioned, there are some hidden costs associated with getting products from factory to the buyer's door. Sometimes the true cost may seem opaque and might have a huge impact on the bottom line. Knowing the total landed cost can help you understand the product's true costs, which would allow you to assess your business, maximize pricing, and ensure that you are aware of what you are paying for in inventory. Number two, provides the opportunity to analyze your supply chain and find opportunities to cut costs or increase revenues. And finally, helps you determine whether your products are supporting your bottom line or even if the business model is sustainable. If your estimates are too high, then you might be losing out on sales because of pricing. If estimates are too low, then profitability could suffer. So prior to making a deal with a vendor, you should always understand exactly what the contract covers, especially the delivery terms, as there are a number of options, and they do outline the seller, buyer responsibilities and liabilities. So product cost might sound straightforward, as it is how much the vendor is charging for the unit of a product you want to buy. However, there are factors in the contractual agreement that could impact the actual cost you incur, which is basically the other components that are included in the landed cost formula. So for instance, a minimum order quantity or payment terms, delivery terms, lead time, reliability of the shipping lines chosen, as among other factors, could impact the final cost. So say you're based in the US and you get two quotes from suppliers. One is based in China while another one is based in Mexico. The Chinese supplier quotes 40% cheaper. Who would you go with? I mean, that's not enough information. You'll need more information to be able to assess. You need to know what is the transit time, freight costs, as well as other components that we will be going into during this discussion. There's a bunch of factors impacting the landed cost. The way to ensure you've included all of them is to keep thinking about the product's journey and what bills you'll have to pay to complete each milestone. So here's a number of items. Some are not so obvious, while others may be factored in the contractual agreement with the seller. And if that was the case, then there wouldn't be any bill to pay, so it would already have been sunk within the payment of the to the seller. So to start off, there's the minimum order quantity or certain commitments. These set the lowest quantity that can be ordered, and in most cases, it will dictate the packing type and modes of transport. So say a minimum order for shoes is 10,000 pairs. That might be too expensive to ship by air on a per unit basis compared to if the minimum order quantity was only one pair. And payment terms. So the method of paying to seller, that's very important. Was a bank involved, or was it on basis of prepayment or cash against documents? Payment terms will have an associated cost, especially when banks are involved or when the cash to collection cycle is very long. And this could be due to the product lead time or transit time. This would basically tie up capital and have a direct impact on your working capital. So third, lead time, which is the time for the order to be processed, manufactured, and ready for delivery. It is extremely important to factor the time component in when comparing options. So consider this. A long lead time to have an order shipped means you're tying up cash, foregoing its use for other opportunities. Or you might be incurring interest if the amount was bought through a loan or a line of credit. In addition, you might have promised a client to deliver by a certain window, and every day of delay would translate into a penalty cost, or worse, a loss in sales. One way you can factor time when calculating the total landed cost is by multiplying the value of the amount paid times the interest expected to be paid during that period, if there was no penalty cost associated. The longer transit time options and higher cargo value would lead to a higher opportunity cost in lost time. Alternatively, if you do have a penalty cost associated, then that can also be taken into account. So number 4, delivery terms, or the terms of trade, otherwise known as the Incoterms. These are very important. They set the terms of the delivery responsibility and liability between the seller and buyer. The Incoterms rules feature abbreviations for terms like FOB, DAP, Ex-Works, CIP, all of which have precise meanings for the sale of goods around the world. There are 11 Incoterms grouped into 2 categories. 7 can be used for any modes of transport, while 4 of them are specific to sea and land transportation. So you can find these abbreviations online, and they are updated every few years. But the easiest way to memorize them is to think about them into 4 main groups. So the E term, which contains 1, and it is Ex-Works. All delivery responsibility and liability is on the buyer. So the buyer buys from the factory floor of the seller, and they will need to arrange for the collection, freight, customs, finally delivery. Next is the F terms, and these includes 3 terms. Basically, the seller has the responsibility to deliver up to a certain port of origin. So think of freight on board, FOB. Then the buyer has to arrange for the carriage from that certain port at origin to importing and delivery to site. The third category is the C terms. And here the seller has a responsibility to deliver to a destination port, and the buyer has to then arrange from that destination port to arrange for customs clearance and delivery. So think of CIF, which is cost, insurance, and freight, or CNF, which is cost and freight, up to the destination port. And finally, there's the D terms, and there's 3 categories within it, or 3 abbreviations within it. The seller here has the responsibility to deliver up to a location determined by the buyer, and would include customs clearance, depending on which term. So seller might have to pay for the duties and taxes, or it could be on the buyer's account. So if the term was DDU, delivery duty unpaid, then the seller would deliver to site, but any costs of duties and taxes would be on the buyer's account. Whereas DDP, which is the most extreme case, is delivery duty paid, means that the full delivery to site is on including duties and taxes are on the seller's account. So the 2 most extreme cases are Ex-Works, where under this, the buyer has the highest risks and responsibilities of delivering from the seller's yard or a factory floor. And the other extreme case is DDP, where the ultimate responsibility is on the seller to deliver up to the buyer's location. So the reason Incoterms are important when calculating the total landed cost is, if the terms are DDP, for instance, then all costs are borne on the supplier. While if terms were Ex-Works or FOB, then the buyer would have to nominate a freight forwarder or a carrier to arrange for the transportation. And these costs, including duties and taxes, would have to be paid at a port of destination, will also be needed to be taken into account. So DDP, as a buyer, you wouldn't need to consider the costs associated with shipping and customs. Whereas if you've chosen any of the other options, then you will need to look into different freight rates and freight options, carriers, and considerations. The tricky part is there's no fixed percentage you can apply when calculating cost of freight or duties, as it all depends on a number of factors like the cargo value, mode of transport, service level, what carrier, different carrier options, and so on. So consider this. Prior to 2019, freight rates for a 40-foot equivalent unit container from Shanghai to LA would be in the thousands, say around $2,000, while in 2021 they skyrocketed to 10 times that per 40-foot equivalent unit. And that is why it is very important to keep up to date with the markets and always reassess your supply chain strategy when it comes to sourcing internationally or selling internationally. Point number 5 is shipping, my favorite topic. So for international transportations, there are really 3 main modes of transport. You got air, land, which could be road or rail, sea, which could be in form of bulk vessels or containers. And within containers, you can have a less container load option, which is LCL, or a full container load option, which is FCL. And the 2 most common types of container sizes are the 20 foot and a 40-foot container. And some factors to consider when selecting the transportation mode is what is the shipment size, the origin, destination, that can tell you, what options are there. Some ports or some destinations are not as connected as others. What are the freight rates? Obviously, that's extremely important. How badly do you need the shipment? What are available options? And finally, the transit time. How long would it take? Once the transport mode is selected, you can then compare different carrier options. Some of the criteria that could be included are, obviously, number 1 is the freight rate, the origin destination charges. So those would be, it could be the port costs or the booking charges that are to be paid either to the line or port. Number 3 is the transit time, and 4 is the carrier liability. So how reliable is the carrier? The transit time is how long would it take for goods to be delivered from point A to B, measured in hours or days. For the shipping component, the Incoterms plays a significant role, as we mentioned, as to which part of the shipping to include in the calculation. So if it's X work, then you'll factor in the port charges, customs clearance, inland component, storage. If there's any other booking charges that are to be paid to the liner or freight forwarder. Whereas if it's DDP, then you don't consider, you don't need to think about these. Maybe it would be good to know as to which carrier they're nominating, what is that carrier's reliability, transit time, as in case it's not favorable for you, then you would try to renegotiate your terms with the seller. So even though you don't have to, for the DDP, you don't have to worry about the actual, shipping, booking, and the whole freight leg. It would be really good to know the details, just so that you can also assess yourself if that option is favorable to you. Number 6, duties and taxes. So duty is the amount of tax paid on an imported good. It is collected by the importing country via customs. That amount is usually determined by 3 factors. Number 1, the type of good, i.e. their classification, and this is based on the harmonized tariff schedule. And number 2, their value or their valuation at customs. And number 3, the country of origin. As certain countries might have, or different countries have different trade agreements. Some might have a free trade agreement where you would pay zero duties, while others might have a certain duty structure involved. Taxes, some countries collect additional taxes, sales or income tax on the imported goods. Different countries set different methods for cargo valuation. Some calculate it based on the cargo value, while others based on cargo value plus cost of transportation. This is called the dutiable value. So countries calculate the dutiable value based on either FOB or their CIF value. So I suggest looking into a duty calculator for the country you are importing from. And for instance, in 2020, when ocean freights skyrocketed, this presented a challenge to certain countries that use the cost plus freight method to calculate the duty amount. So this is like extremely important to know how are the duties calculated. Some countries, as mentioned, have trade agreements which would encourage businesses to source from these countries that have a free trade agreement with their own, just to avoid paying duties. There's also workarounds. Consider a textile business that is owned by a Chinese organization but wants to sell in the US. They can actually manufacture finished products in a country that has an FTA with the US. When not dealing with your own native currency, you'll also have to factor in the currency conversion, especially if there's any risks of fluctuation. Finally, the last two components in the total landed cost formula I've mentioned earlier are the risks and overheads. So risks, you can think of it as the components of the landed cost that can be related to risks that have to do with a vendor or carriers not delivering on time, any compliance issue, quality, safety, product deficiencies, or could also be currency risk or loss of sale because of certain reliability issues. So these you can put a certain percentage on. It all comes down to what the product is and who are you sourcing from, the carrier, what are the issues, what are the markets, what are they looking like, are there any delays, equipment shortages, and then the overheads can be related to the documentation processing of staff, the cost to conduct a due diligence, any storage or handling requirements to ensure the final delivery. So now we know most of the general cost centers to consider when calculating the total landed cost. A big thing to note is there's no set amount as to how much percentage to allocate for each component of the landed cost. But a good starting point will be how much are these other components costing you relative to the actual product cost? And will you be able to recover them? How much are you selling the product for? Are you making a profitability? Before we end this session, it would be good to quickly go through like some high-level learnings out of the COVID-19 pandemic vis-a-vis supply chains. So COVID-19 hit the world by storm towards the end of 19, created massive shocks in supply chains that made businesses reassess the way they place orders. Freight rates skyrocketed, supply became very scarce, and reliability decreased with shocks in the freight market. Sourcing from China to the US became extremely expensive due to freight rates, longer transit times, variability in delivery. There was shortages in container equipments. Vessels would wait months to get into ports. This was something that was very unexpected. It was a big shock in the market. And I think this, presents a huge learning that businesses need to think of the unexpected or have a plan B in place. Knowing your total landed cost would help you assess different aspects of the costs associated with the products you are sourcing or selling, and basically support you adjust your sourcing and procurement strategy and set up a good decision system that brings in or builds in more resilience into your supply chain. And a really big takeaway from the supply chain shock during the COVID pandemic is to know what's going on in your supply chain, especially when you are dependent on international markets. So you have international buyers, or you're sourcing from international vendors. You should always, know what's going on, even if the way you buy are on DDP basis and you're not involved in freight. And knowing would help you make should help you make better decisions moving forward and plan for the unexpected. As I conclude this session, I do hope I've highlighted the importance of total landed costs, as they are extremely important for businesses to assess options, to know where the business stands in terms of product profitability, and support them with sourcing, procurement strategies, and ultimately supply chains, the business's supply chain strategy. Remember this: the lowest offer doesn't always translate to the lowest total cost. As the formula is too general, it is the business's job to identify the relevant costs associated with the total landed cost based on the Incoterms they use. Finally, thank you for your time in watching this, and do hope this session was helpful. In case of any questions, please feel free to reach out.